Hey, what can I say? I love doing this. This is so much fun. Where else would I rather be on a Sunday night than hanging with you guys? All right, and of course, what could be better? This is what I read before I go to sleep every night because it just puts me to sleep. All right, everybody, let's get right into this. So we cracked down a bit today, but generally the week was a positive week. We made a higher high, a new all-time high on the S&P 500. In fact, Purple Predictor stalled out a little bit, but I'm looking at this as just kind of a regular, normal sort of a day, no big deal. Now, this is a little bit more disturbing because if you look in the upper right-hand corner, we can see that the red line and the green line are now equal. And what that means is that buying pressure and selling pressure are exactly equal. And that's not good because, as you can see, we've had the green line higher than the red line now for a month and a half, which is what bulled us to these new highs on this move. So this is a degradation, let's call it right now. It's not a sell signal, but it is definitely a degradation. Then when you add in, though, the fact that we gapped lower today on all three indexes, that's not a good sign. So it's not the beginning of a bear market, let's be clear about that. All the other conditions are still pretty darn good, but it does mean we're in for a short-term sell-off here this week. Seasonality remains on a bullish buy signal, so that's one of the background factors that keeps me bullish. If it breaks below that red line at about 161 and a half, 162, then I'm going to get out of the bullish seasonality. But right now, it's held up through this whole summer period. Normally, it's sell in May and go away, but here we are. We didn't sell in May. The market accelerated in May. That's why when people use seasonality, they use it wrong. Remember, I wrote the book on this in 1979. I'm telling you the right way to use seasonality. This all right now, we should be drifting sideways or lower, then we should expect a pretty strong rally in the fourth quarter. Now the yield curve, let's go into a little bit more detail here. The yield curve is a 1 year forward leading indicator. So what this is telling us is that next year, pretty much going to be blah. It's not going to be that great. But I'm also keeping, and really that whole dotted line is to say really up until May of next year, the yield curve is not going to be telling us much at all. It's going to tell us that the market's just going to maybe follow normal seasonality. But what I'm really looking at is in the lower right-hand corner where the yield curve is getting tight. It's not to the point where we're going to have a crash or anything like that, but it is getting tighter and making me nervous. But remember that it's a 1 year leading indicator. So if it gets tight in the lower right-hand corner, all that means is a year later we're going to have a crash. So we got a lot of advance notice here. Asset allocation had been a really bullish feature, but it kind of crapped out this week as well, showing that money went out of the stock market and into bonds. Stock market risk indicator, on the other hand, bounced. This tells us that people want to be in risky assets, which is the opposite of the previous chart. Kind of confusing there. Now, global shares completely crapped out. As you know, I've been having no desire to be involved in these things at all. But unfortunately, I was promoting being long Australian shares, and they crapped out. So we got to give up the ghost on this trade. Bonds, as I mentioned, money went into the bond market. Look at it rally here. Now, remember, a rallying, if the bonds are going up, that means interest rates are going down. Let's take a look at our indicators here. The indicator that I highlighted last week was the blue line, which popped up, but you can see it's now going down. Now look at the blue line. That's 10-year yields in Germany. That's the most important factor right now for the U.S. bond yields or note yields. And you can see it's in a clear bear market, suggesting lower interest rates. Look at the gold line. That's the price of gold. Down, suggesting lower interest rates. And then look at the chart itself. That's the CRB, also a leading indicator for interest rates. It's pointing down, also suggesting lower interest rates. Am I building a case for lower interest rates? A bull market in bonds? You better believe it. Okay, and fully paid up members know I'm already long bonds. Okay, the dollar. Now this is starting to develop into a very interesting situation. You can see we're in a kind of sluggish bull market here. I'm looking for the dollar to accelerate even though bond yields are going down. So look for this to break out to the upside. And by the way, why? Because the U.S. economy is stronger than anybody in the world. And most importantly, it's much stronger than Europe because this index is dominated by Europe. So look for the U.S. dollar to break to the upside on the back of stronger economy than pretty much any place in the world, okay? Now, gold. I've drawn a couple of lines on here. This has been an amazing bear market here. And I have to say, I missed it. I called a lot of it, but I never got short gold. So you can see right now that we have, the red line just shows that there's a major bear market. Okay, duh. But we're starting to see what's called a descending triangle in the yellow lines. A descending triangle should be broken to the downside. So a break below 1210, I would want to get short. Now, it may only be for $50 on the downside, maybe $40 on the downside, but a descending triangle in the context of this major bear market means it could go a lot lower, a lot lower. Now, the only thing that's kind of saying, wait a minute, maybe it could start to pop up was the lower interest rates, but I don't think so at this time. So look for gold to break down, and a break below 1210 would get me short. Our indicators, though, the top indicator is bearish, the middle indicator is neutral, and the bottom indicator is bullish. So this is saying things are neutral, and of course, as I showed you in the previous chart, they have been neutral short term. But if they break down, I'm going to get short. If they break up, I don't want to do anything. Okay, oil did exactly what I told you it would do last week, and I think we're just going to stay in this sideways range here for a while. Now, Bitcoin, what a piece of garbage. I mean, really, this is such a piece of garbage. Look at what's happened. We got the rally. Last week I told you I thought we were going to head down, and we did head down. Now, and look at the purple predictor. The purple predictor broke to new lows. This is quite bearish. It shows that the smart money is giving up the ghost on Bitcoin, and that we're going to break below that 5,800 level that we've talked about now for a couple of months. If it breaks below 5,800, you've got to get short. If you're long Bitcoin, you got to get out of your Bitcoin because that would be a signal of a significant bear market. All right, coming up, a lot of events. Check out CourtneySmith.com for details and to sign up. We get all of our trade ideas. Highly recommend that you check out Stock Butler. I think you're going to love it. All right, that's it for me for this week, everybody. We will talk to you later, freebies, and fully paid up members. Just hang in there because some pretty interesting developments in some of our indicators, and we've got a couple of new trades for you. So hang in there, fully paid up members.